This is Al Brooks, and this is my price action trading course. This module has to do with trading weak bear channels. Is a channel weak or strong? Take a look at the module on channels. So if you have a bear channel, is it weak or is it strong? Sometimes it's impossible to tell, but it doesn't really matter, because if there's any question, assume that it's strong and only look to sell. Bear implies trend, lower highs, lower lows. Channel implies weak trend, in contrast to the breakout phase, a strong trend. Sometimes weak trends can be very strong, but I use the term synonymous with channel and in contrast to spike or the breakout phase. The weaker a channel is, the more likely trades in both directions will be profitable. When it's weak, it'll have broad swings, lots of two-sided trading. If it's reasonably strong and the bounces up are not very big, it's better only to trade in the direction of the trend. In other words, sell. Sometimes it's impossible to tell whether the market is in a broad channel, a broad bear channel in this case, or a trading range. And very often it's in both. But it doesn't matter whether or not you know that it's a channel or a trading range. You trade them the same. You buy low, you sell high, and you scalp. In fact, most weak channels, up or down, begin as trading ranges. So what are the components of a weak channel, a weak bear channel? You have overlapping bars. You have weak follow-through after bear bars. So you'll have a bear trend bar and then maybe a bull bar. Many bars will have tails on the bottom, meaning that there was buying into the close of the bar. And you'll also have a lot of bars with bull bodies. So you'll go down and then a bull body up, maybe two bull bars up. The pullbacks will be obvious, some of them lasting many bars, and it essentially looks like a trading range that's tilted down. Take a look at what we have here, all right? Clearly a trading range, right? But look at what's happening. We have a high, lower high, lower high, lower high, low, lower low. So yes, it's a trading range because we're mostly sideways, but it's also a bear channel because we're forming lower highs and lower lows. And by definition, that's a bear trend. It's not a bear spike, and therefore it has to be a channel. It's weak because there are a lot of bull bars within it, many reversals, and prominent tails on the bottoms of the bars. Traders can look at this and say, yeah, bear breakout, two big bear bars, but three pushes down and it's becoming parabolic. It's accelerating downward, and it could simply be a parabolic wedge or a failed breakout below this double bottom. However, this bull bar has a tail on top, so it's not a strong bull bar, and its body is small compared to these two bear bars. So this bull bar is not sufficiently strong to reverse these two bear bars. So I would not be looking to buy. I would assume that we're still in a bear channel and we're still forming lower highs and lower lows. Alright, well here the buy never triggered. Now we have another push down and maybe we're forming a parabolic wedge. Three pushes down, becoming increasingly sloped, and we have a second attempt to reverse up. We had this bull bar, and now we have another bull body. So you can argue it's a second signal. The first never triggered. To me, I would not buy that. This small bull body is not enough to overcome all this bearishness. Yes, it could end up being a failed breakout of the double bottom. It could end up being a higher low after this low. We're forming higher lows and higher highs. So it could be part of a larger bull channel. But to me, this is not a strong enough buy signal. Okay, I think this is interesting. And this is very common in the early stages of a channel when you're deciding whether it's still a trading range or it has become a channel. All right, very strong bull bar, follow through a bull body, and then another strong bull bar. However, we're still below the most recent higher low or lower high, right? So if you're a bear, you can take a bet that the market will continue to form lower highs and lower lows. You could sell this strong bull close saying Yeah, it's strong, but it might be a sell vacuum test of the top of the channel. I'll sell the close with a stop above the most recent lower high. So my risk is from this point to this point, and if I'm right and it is a bear channel, I'll get a new low, and my reward is several times bigger than my risk. So it's a reasonable short. As far as the top of the channel goes, you can draw it across these highs, and we're not quite there. And you can also do a best fit type of channel. You know, channels are rarely perfect. However, even though we're not at the top of the most obvious channel, we're pretty close to it, and this could be the top. Bears who did not want to sell the close of a pretty strong bull spike might be willing to sell below a second bear bar. So we have, below a 2-bar reversal. We have an up bar and a down bar. By the way, this is a weekly Forex chart, the euro versus the dollar, and these bars are very big. Each bar is about 500 ticks tall. So you can bet that the bear channel will continue to form lower highs and lower lows, and you could sell below the low of this bear bar and put a stop just above its high. So if you sold on a stop 1 tick below the low of that strong bear bar, you'd be filled right here, and you'd probably put a stop above the high of this very big bear bar. Risk 564 ticks. When you look at this, you don't say, oh yeah, this is probably going down. You look at it and say, I don't know, maybe it'll go down, maybe we're trying to form a higher low major trend reversal, maybe we'll go up. Okay? So you're uncertain. That means you need a reward at least twice as big as your risk. So when you take this trade, your initial risk is above this bear bar, so 2 times that initial risk is down here. So this would be your target if you took that short, or at least it would be your initial target. Okay, good bar for the bears, right? You entered right here, and now you have a strong bear close. You might tighten your stop to just above the high of this bar. You could put it above the high of this bear bar. I probably would put it above the high of my entry bar. So at this point, we have a strong bear bar, and you're not going to let it come up again. So at this point, you can calculate your actual risk. Okay, you shorted 1 tick below this bar, so you're short here. And at this point, your actual risk is 1 tick above the high of this bar. So if your initial stop was 1 tick above the high of this bar, you would not have been stopped out, and you'd still be short. So your actual risk is from your entry price to 1 tick above the high of the entry bar, 252 ticks. You can adjust your reward. So instead of basing it on your initial risk and putting a target down here, you could base it upon your actual risk, and 2 times your actual risk is right here. And you could try to get out right here. And this is, I think, a more realistic objective. So you would have had a limit order to buy back half or all of your position at 2 times your actual risk, and you would have exited as the market fell below your limit order. The market continued to fall, and then we have a 2-bar reversal, a bull bar and a bear bar. It does not matter that there's a bar in between. On some higher time frame chart, these 2 bars will probably form a reversal bar. All right, I don't have a trend channel line drawn in here across these lows, but this would be pretty close to the low of the channel. You can argue micro wedge, 3 pushes down, 1, 2, 3, and a larger wedge, bottom of the channel. If you're aggressive, I think you can buy above this 2-bar reversal, above this strong bull bar, betting that we'll get up to the top of the channel. I think the probability is not high, so if you are to take this trade, it's not a high probability trade. You have to be going for a reward that's 2 times your risk, which would be up here. Could be a final flag. This II pattern could be a final flag, so this could be a final flag reversal. This is 12 bars down without a pullback. Every bar has a high up below the low of the prior bar. In general, if you have a big micro channel and a bear trend, it's usually better not to take the first reversal up. So I think this is a pretty aggressive long. By the time this bar closed, however, it looks pretty good for the bulls. The follow through, not very good at all. Two little pushes down, so a little micro double bottom. And we're at, you'd also, after the strong bull bar, you can adjust your protective stop from below the signal bar. So you can move it from your initial risk to your actual risk. And had you bought above the high of this bar or above the high of this bar, your actual risk would be to one tick below the low of that bar. 2 times your actual risk would be here. So even if the trade is less than 60% certain, right, you can still exit at 2 times your actual risk, and you would have been filled with your limit order as this bull bar went up there. Look what happened on the next bar. I don't have the top of the channel drawn in, but we're probably pretty close to the top of the channel. We have 2 legs up, a strong 2-bar bull spike here, and now we have a strong 2-bar reversal up and down. On a higher time frame chart, that could be a single reversal bar. 3 small dojis, so forming a tight trading range. Most tight trading range breakouts fail, so we're breaking out and we're failing. You can argue this is a low too short. Here's the first push up, here's the second, here's the first, here's the low 1 trigger, and then if we fall below that bear bar, that would be the low 2 trigger. I think this is probably an okay swing short for a test in the area of the top of the channel. This is so strong, we may go sideways in here some. Big down, big up, usually big confusion, and that means sideways. So I also think it's okay to wait for a second signal, especially with these 3 strong bull bars. All right, let's say the pink line, you draw a channel across these 2 highs, you get this pink line. We're not quite up to the channel line. You could draw it as a parallel from a best fit line. You could use this low and this low, or you can use that low and this low and create a parallel, and that's that blue line. If you do that, we are poking slightly above it and reversing down. Channels are rarely perfect, and there are usually multiple choices for the possible lines. In general, you look to short a reversal down from the top of the channel. This is so climactic, I suspect that we probably have more sideways to up. And this is an okay short, but it's also okay to wait to see if we get a second signal. Alright, it would have triggered here, not a very big entry bar, and we're back into this 3-bar tight trading range, so we may end up going more sideways. If you did short below the low of this bar, your stop is still above the high of that strong bear bar. If we get a strong bear bar, another strong bear bar, we can lower the stop to just above its high. And instead we get a bull reversal bar, a possible double bottom, not really a high or low major trend reversal, not enough bars down here. To me it looks like we're still sideways. We got a strong bear bar at this point, so if you're still short from here and you did not exit above this double bottom, at this point, a strong bear bar, you could lower your stop to above its high. So at this point, you can calculate your actual risk. You get in on this bar, 1 tick below that bear bar. The market has turned down, and now your stop is 1 tick above the high of this bar, and your actual risk is 201 ticks. Since it's not certain that the trade will work, in other words, the probability is low, you have to be going for a reward that is 2 times your actual risk, and that would be down here at this red line. Alright, another problem for the bulls, a triangle, 3 pushes down, 1. Problem for the bears, 3 pushes down, 1, 2, and 3. The bulls can argue it's a bull triangle and we'll get a bigger second leg up, and we might. I personally would not take the long. We're continuing to fail at the moving average, and until we break strongly above the moving average, I'd rather assume that we'll fail some more. So the traders who shorted below this bear bar, their stop is above here. Once we fell below here, they probably would tighten their stop to below this bear bar. If traders did not short this bear bar, they could short below this bear bar for a triangle. 3 pushes up, 1, 2, 3, and it's a triangle at the moving average with a close below the moving average right on the low tick. Had you shorted here, you would have been filled at 2 times your initial risk, as this bar fell below your profit-taking limit order. Alternatively, had you not shorted here and you waited for the triangle short, you would have been filled on the open of this bar as the market gapped below that bar. This is probably a more conservative entry, a triangle and a bear, rather than shorting the 2-bar reversal after a pretty strong bull spike. So if you took this short, your initial protective stop is above the high of the signal bar. Your entry is here on the open, so you're risking 200 ticks. The risk is fairly small for a weekly chart, so it's okay not to put your target in. You could go for a reward 2 times your risk. I certainly would not go for a reward only 1 time my risk because the setup is so strong. So what you could do is you could exit 2 times the risk, or you could hold off and wait for some evidence that the leg down is ending and then exit. The market quickly fell with a series of bear bars, a 2-bar reversal but a big tail on top, and a 5-bar bear microchannel. I personally would not buy that. The bulls were able to rally after whatever this is, a 10-bar bear microchannel at this point. This is a possible higher low major trend reversal. We have a bear trend here, a trend line, a break above it, test of the moving average. It's possible that this is a major trend reversal, but 5 bars down and a bull bar with a big tail on top, that's not strong enough. This bar is not strong enough to reverse those 5 bars. And if I were swinging part of my position, I would hold that part short. At this point, my stop would probably be above the high of this entry bar. Whenever you're in a trade, you have to be looking for reasons to take profits. You could exit above this 2-bar reversal. I think it would be okay. I probably would wait for some kind of a second signal. We have 2 pushes up, bull bar, bear bar, bull bar. So this is effectively a low 2 short, and a low 2 short late in a bear trend often becomes the final flag of the bear trend, and a reversal often follows. So you could exit up here. I probably would take profits here. We have an outside bar, strong bull bar, I could see in a possible final flag reversal. So to me, it would make more sense to exit above the high of that bull reversal bar. Okay, weak bear channel. It's a bear trend. So even though there are tradable swings in both directions, and it behaves like a trading range that's tilted down, you want to buy low, sell high, and scalp like in a trading range. You want to sell at resistance and take profits, or even buy at new lows and support. But in general, I want to make sure that I sell. If it's a bear channel, it's a trend, I want to make sure that I take the sells. I don't worry as much about taking the buys at the bottom of the channel, and I only take them if the setup looks especially strong. Protective stops, it's better to scalp most trades like in a trading range. Scalping, I talked a lot about exiting at 2 times the risk, and that to me is a swing and not a scalp. It's borderline. To me, as soon as you start going for a profit that's more than 2 times your risk, I think it's a swing. If you're going 2 times your risk, you can call it a swing or a scalp. In this kind of a setting, since you're not allowing the profits to run, I think of it as a scalp. In general, if you're scalping, you don't want to allow pullbacks, and you get out of your shorts above any strong bull bar and any strong bear bar, because remember, you're tightening your stops. Every time you get a new strong bear bar, you're moving your stop down to above its high. So if the market goes above the high of one of those strong bear bars, it's probably better to exit. Initial stop when you do short is above the high of the signal bar. Okay, so arguably a low 2 final flag. If you draw a trend channel line along the bottom, it's a possible wedge bottom. You can argue it's also a lower low major trend reversal. We have a bear trend line that I did not draw, a trend line break, a test of the moving average, a triangle, which is often a final flag, and the market usually comes back and gets at least back to the middle of the triangle. So I definitely would get out of shorts. As far as going long, if I were flat, I would go long. If I were short, I might reverse. It depends on how I feel. In general, I don't like to reverse. I prefer to get out and wait a few bars before looking in the opposite direction. This is a weekly chart, so I'd have plenty of time to reverse if I wanted to. I could reverse during any one of these bars. This, by the way, this outside bar is an outside bar. This is an outside bar, a little bit bigger than that bar, and here's another one. So it's a micro double bottom. The market went down and up, and then down on these two bars, and then up again. So if you took the conservative entry on the triangle breakout, your profits would be, and you only took the shorts, your profits would be 894 ticks. Remember, this is a weekly chart, so the bars are very big. If you were much more aggressive and you took the earlier entry, well, actually, right here, I'm not showing the earlier short. I'm still showing this, but I'm also showing the buy right here. You would have more profit, 1,300 ticks in profit. Okay, a broad bear channel. Although that particular channel had many features of a weak bear, there really was very little opportunity to buy. And when there's any doubt about whether or not you should buy, I would treat the channel like a strong channel and make sure to take all the shorts and only buy if there was a very strong buy signal. Here's another example, this time using the weekly spider chart. And there's an expanding triangle top, a high, a higher high, and another higher high. To me, this is a weak sell signal. I mean, you could argue an expanding triangle is a major trend reversal, and it is. So technically that's a short, but I think it's really not a strong short. The context is okay for a short. The signal bar is not very strong. Had you shorted below that bar, you'd look at your actual risk, which was 1 tick above the high of this bear bar, and you try to get out at 2 times your risk. The probability is not high, so you want to take a reward 2 times your risk. So you probably would have been filled at this bar, and probably a lot of traders did that same thing, 2 times their risk, and that's what created this bear bar. This big bull reversal bar. All right, so now we have a second attempt down. So this is a pullback from this bear breakout, and I think it's an okay swing short. We're in a trading range, but we have an expanding triangle top, which is always a higher high major trend reversal. So we may get a second leg down. Chances are we will. Since this is a pullback from this very strong breakout, and we now have evidence that the bears are strong, I do think that is an okay short. Expanding triangle tops usually test down to the bottom of the expanding triangle. Right now, we're still in a trading range, but we also have an expanding triangle top operating. So what's going on at this point? Okay, so if you took that short, you'd probably take some profits, certainly on this reversal up. What about buying? We have a double bottom. We have 2 small legs down. Very strong 2 bull bars. I probably would wait for a breakout pullback buy, like maybe above this bar. But with the expanding triangle top, you can call it a double top, expanding triangle top. You can call it a higher high major trend reversal, or you can call it a double top major trend reversal. You could make the bear case. We don't yet have lower lows, but we are starting to get small lower highs. So I do think you can short this as a double top bear flag, and on the premise that the market will have more down. So I do think this is an okay swing short. I don't think it's a good scalp. We got too many bars up, and we're still in a trading range. So look what happened. So let's say you took this short below this bear bar, and you put your stop above the high of the bar for your initial risk, and then the market started to turn down on this bar. As it's turning down and this bar is forming, you'd look at it and say, my actual risk was 1 tick above the high of this bear bar, and therefore you can try to get out at 2 times your actual risk. You could place a limit order here at 2 times your actual risk, and you'd be filled there. You could either take all profits or partial profits. At this point, we're at the bottom of a trading range, right? So you can only hold short here if you're betting on a swing. But it's okay, I think, to take total profits. Okay, this is what followed. More bear breakout. Now a possible double bottom. The bulls can argue 2 legs down, 1 and 2, and then a double bottom, and a rally. Those swing bears who are still short, they probably have their stops at break even, certainly above this bar, certainly above that lower high. Now the bears, if they want to press their shorts, betting that this is really just the first leg down of 2 legs, okay, and that this is just a 2-legged correction, a large low 2 with a very strong outside down bar. Let's say they were aggressive, they could take this short. They could short below that bear bar and bet that maybe we'll get a leg 1, leg 2 move down. Here's leg 1, and then maybe we'll get leg 2 down. Low probability. Look at all this buying pressure in here, all these very big bull bars. So low probability, so you have to go for a reward that is at least 2 times your risk. Okay, the first leg down is mostly in a channel. Yes, a very broad channel, but it might be the first of 2 larger legs down. Again, with all this buying pressure in here, I think it's a low probability short, but it's okay to take it if you're going for a target at least 2 times your risk. And this is that entry, and this is what that entry, and this is what followed. The market just absolutely collapsed. A triangle in here, 3 pushes up, 1, 2, 3, possible final flag, strong bear breakout, probably consecutive sell climaxes, very climactic behavior all the way down, probably unsustainable, and now we have a potential final flag, and we have a 2-bar reversal, either this bear bar or that bear bar. I think it's probably good to take profits on shorts at this point. After consecutive sell climaxes and a potential final flag and a lower low major trend reversal, the odds are that the market will have at least 10 bars and 2 legs up. Okay, a broad bear channel. The broader the swings, the weaker the channel, the more it behaves like a trading range, and you can trade it like a trading range. You can buy low, you can sell high, and scalp. Okay, here's an example of a very broad bear channel. Lower highs, lower lows, but also a trading range. Most channels begin as trading ranges, and while they're still trading ranges, you usually can trade in both directions. So in this, when the market looks like this, I think you can look to buy low, sell high, and scalp. So when the market reverses up from a new low, I think you can short. When it gets near the prior high, you can sell. Here's what I'm talking about. You're selling right below prior highs, and you're buying anywhere near the bottom of the trading range. Even though ultimately this may become a very strong bear channel. At the moment it's a bear channel, but it's also a trading range. This is just one other channel that I'm mentioning, shrinking stairs. It's actually a fairly strong bear channel. It's fairly tight. However, I'm only mentioning it because of the scalp opportunity that it offers for experienced traders. Okay, this pink box is from the most recent low to this low. We pulled back. This pink box is the size of the next breakout, and then we rallied. So traders see that this pink box is smaller than this one. So this breakout is smaller than the prior breakout. So each step down is becoming smaller, and experienced traders will use that for a scalp. They'll expect this breakout to be smaller than this one, so they will place a limit order to go long at less than the height of this box, and they'll look for a scalp up at least to the bottom of the prior breakout, and probably up to the moving average. Obviously a bear trend, so obviously you take the shorts, but you can fade the breakouts, betting that the next breakout will be slightly less than the prior, because that's what's happening over here. And that's the end of my module on trading weak bear channels.